The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Secure Act 2.0. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber. Welcome, everyone. I know that this is a popular topic. The Secure Act 2.0 passed, basically in the last month, and so we're going to talk about not all of the provisions, but some of the provisions. If you don't have an overview of or some kind of summary of all the provisions, make sure that you contact us after today's webinar and ask for the supporting materials, because it will cover more than we're able to cover today during the 15 minutes or so that we're going to be together for the free webinar. As a reminder, we do this webinar every month, and March's topic has already been decided. It's what to know about gift taxes. It will be held on March 1st. Every one of our webinars is on the first Wednesday of the month at 11 o'clock Central Time. It is a no charge webinar. It's open to anyone who might be interested in the content, so feel welcome to let colleagues know about the webinar and invite them to join if they're interested. We'll be glad to have them. What we do need to decide when we're together today is what the topic will be for April. The three choices are: first, the trustee's obligation to irrevocable life insurance trust beneficiaries. The second is stranger-owned life insurance is still dead. And the third choice is starting the buy-sell conversation. I will invite you to vote in the poll, which I will open in a second. Yeah, technical difficulty. Now the poll is open. If you would, please go ahead and vote. And we will use your selection for April's webinar. We'll leave the poll open for another 10 seconds or so. There are a few of you who haven't voted yet. All right, we'll go ahead and close the poll, and the April topic will be starting the buy-sell conversation. Thank you for voting, and thank you for your interest in our webinars. So let's go ahead and get started and talk about Secure Act 2.0. The Secure Act 2.0 does not simplify anything. As you can see from the screenshot that I pulled from the Senate's, the United States Senate's website, the Secure Act was part of the Consolidated Appropriations Act of 2023, and that whole act ran over 4,000 pages. Now, I'm not going to tell you that I read all 4,000 of those pages, but the act itself has a significant number of pages, but legislation from Washington generally does not make things simpler. It tends to make things more complicated. And this part of the Consolidated Appropriations Act of 2023 is no exception. The index goes to multiple pages, and on the 5th page of the index, you can see that the Secure Act is finally referred to there. So the Secure Act is a relatively small part of this overall appropriations package, but it's an important part for us as we work in our business, and we'll go through some of the important provisions here in just a second. So I'm going to talk about 6 things that were included in the Secure Act. There's much more, but I think 6 things that I picked out that are perhaps the most important. The first one is the increase in the minimum distribution age. So for those who turned 73 last year, or excuse me, for those who turned 73 this year, the RMD age is 73. And so it's raised immediately. Excuse me, for those who turned 72 this year, the RMD age is 73. And so there we go. And so that's the deal. It's not 72 anymore. And so those who turn 72 this year get to defer RMDs for this year, and they only have to start next year with their RMDs. The rules with regard to RMDs have broadly stayed the same, other than the increase in the age, and that is that if you've got somebody working for an employer sponsoring a non-IRA plan, and if that person is not the owner of the company, and if that person works the entire year, even if they're already 73, they still get to defer RMDs from that employer-sponsored plan. Also, if it's the first RMD from a particular account, in general, the RMD can be delayed past the end of the calendar year till April 1st of the following year. So those rules have stayed intact. One other thing about the increase in RMD is that those who were born in 1960 or later will start RMDs at age 75. There's a little bit of ambiguity in Secure Act 2.0's language. It's possible that those who were born in 1959 will also get an increase in the RMD age to 75. But for sure, those born in 1960 or later, their RMD age will be 75 because that's what the Secure Act 2.0 says. So certainly something to talk to all of our clients who are at or nearing retirement age, the change in the RMD age. The next thing is that the Secure Act 2.0 created a lot of new exceptions to the age 59 and a half penalty tax with respect to IRA or qualified plan distributions. And so the first one is available immediately, and that is those who are terminally ill get an exception to the penalty tax for IRA and qualified plan distributions. In the past, terminally ill people would only be able to get an exception to the penalty tax if they were disabled. Well, not everyone who's terminally ill is disabled, and so there's a specific exception now for terminal illness. And the even better news is that they've expanded the definition of terminal illness to someone whose doctor has certified that they have a life expectancy of 7 years or less. And it's not 2 years as it would be for life insurance accelerations, it's 7 years or less. So brand new penalty tax exception for terminal illness. The next new exception is not available yet, but will be available in 2024. That is that if someone has unforeseeable or immediate financial needs related to personal or family emergency expenses, they're allowed to take up to $1,000 out of their qualified account without the penalty tax. It's not a big deal. It's not much for most people. $1,000 ain't gonna make or break somebody's lifestyle, but it is new and it will be available in 2024. Also beginning in 2024, up to 10 grand is going to be available to those who have been victims of domestic abuse within the past year, up to 10 grand. The question comes up, well, how is somebody going to be able to prove that they were a victim of domestic abuse? And the answer is the law allows them to self-certify that they have been a victim of domestic abuse in the past year. And so beginning in 2024, they're allowed to take up to $10,000 out without the penalty tax. And oh, by the way, there's an extended rollover possibility. Within 3 years of taking the distribution, the amount can be repaid and be treated essentially as a 60-day rollover. So that's some good news. Another exception to the penalty tax is that people beginning in 2026 can direct up to $2,500 from a qualified account to be paid toward long-term care coverage. It's not exactly clear what qualified long-term care coverage might be, whether some kinds of life insurance policy accelerations might qualify for the $2,500 a year exception to the penalty tax. We'll wait for regulations on that because this provision is not available until 2026. And then the final new thing is that with regard to governmental plans, there's currently an age 50 exception for public safety officers, and Secure Act 2.0 expands the definition of public safety officers and those who might qualify for the age 50 exception to the penalty tax. That's beginning immediately for those who qualify. And if you're looking for more information about that, give us a yell. So those are the new penalty tax exceptions in the Secure Act. The QCD rule provisions have changed a bit. The biggest change that got our attention, but when we thought about it a little bit more, really isn't much of a change, is that the Secure Act creates this opportunity to make a one-time QCD gift of up to $50,000 to a split interest entity. A split interest entity meaning charitable remainder trust or a charitable gift annuity. And that seemed like a big deal. The problem is that the Secure Act 2.0 restricts the CRT portion of this into so that this $50,000 can be deposited only into a CRT that's been put together for the purpose of receiving a QCD gift. And so what does that mean in the real world? What it means in the real world is you gotta create a CRT if you're gonna make a gift to a CRT of 50 grand under the QCD rule. And in general, the cost of creating a CRT and administering a CRT makes it less than sensible for just about anybody to only give 50 grand to the charitable remainder trust. So in the real world, that's probably not going to be much of a thing. It may be that some people will decide to direct up to 50 grand out of their IRAs to a charitable gift annuity, which is something the charity offers. The charity gives back a small income stream in exchange for a gift that somebody makes to them. It's the poor. It's sometimes referred to as the poor man's CRT, and so perhaps there'll be some activity there. But you know, this headline is a bigger deal, I think, than the actuality. And then one other change to the QCD rules is that the 100 grand limit is going to be indexed for inflation in the future, beginning in 2024. So 100 grand will go up bit by bit over time with regard to the QCD ability. So the next thing I want to talk about is slightly liberalized Section 72T distribution rules. So 72T is the section that says if you're younger than 59 and a half, you pay an extra 10% penalty tax on qualified plan IRA distributions. One of the things that hasn't been clear in what the IRS has published in the past is whether or not if you take an IRA account, for example, and you annuitize it for the life of the account owner, does that meet the 72T requirement of substantially equal distributions based on life expectancy? I've always thought the answer was yes, but more conservative folks pointed out that the IRS never said explicitly that the answer was yes. The IRS gave us some safe harbors for how to calculate 72T distributions, and annuitization for life was not one of the safe harbors. Well, in the language of the Secure Act 2.0, annuitization for life is explicitly a safe harbor and does qualify for 72 treatment, and so the penalty tax can be avoided by annuitizing a qualified account. What's also been included in Secure Act 2.0 is the possibility of rolling over accounts from which 72T distributions are being taken. In the past, the regulations prohibited people from making rollovers from those accounts. The regulations were explicit that a rollover from an account being used for 72T distributions was considered to be a material change. Under the Secure Act 2.0, rollovers are permitted. Now you got to still keep on following the 72T rules with regard to the existing and new account, but you can do a rollover and it is no longer considered to be a material change. Another change as a result of the Secure Act 2.0 is there's now an extended deadline for solo Ks. So if you've got somebody in a one owner business, one employee business who is the owner, in the past, the deadline for making salary deferral elections and implementing a solo 401k has been the end of the calendar year for those who are calendar year taxpayers. Now the deadline to make salary deferral elections and to implement the solo 401k is the return deadline for the year. Now, note, it's not the extended deadline, it's the regular deadline. And so for those organized as some types of businesses, that means the deadline is now March 15th of the year following the calendar year of implementation. And for other types of businesses, like Schedule C businesses, that'll be an April 15th deadline for implementing and funding a solo K with employee deferral contributions. So that's a liberalization of the rules that will be good for some of our clients. And then the last thing that's included in the Secure Act 2.0 that I wanted to touch on today is the change in the minimum distribution penalty. So if you've ever had a client miss an RMD, you know that they're risking a 50% failure to take RMD penalty tax. That's the bad news. The good news is the IRS has had a system to allow people to take an RMD late and basically apologize to the IRS and ask the IRS to waive the penalty. And if that procedure was followed and the person asked the IRS to waive the penalty in a timely way, in our experience, the IRS routinely waived the 50% failure to take RMD penalty tax. Well, Secure Act 2.0 changed that missed RMD penalty from 50% to 25%. And if the failure to take RMD is cured in a timely way, in most cases it's within 2 years of the failure, then the IRS would automatically reduce or will automatically reduce the penalty tax from 25% to 10%. Now, what Secure Act 2.0 doesn't address is whether or not the IRS will still have the ability to waive the penalty tax for someone who requests a waiver. It doesn't say anything about whether the IRS will in fact in the future waive the penalty tax, or will just routinely apply this new 10% penalty tax that that is kind of the safe harbor for curing a missed RMD late. We'll have to see how that plays out. I'm skeptical that the IRS will continue to waive the penalty tax on a routine basis. I think my own prediction is that people will now be paying 10% penalty tax routinely on the RMDs that they miss taking in a timely way, and then fix within the safe harbor deadline. So that's something to keep in mind, certainly something to talk to our clients about. A couple of things that I wanted to mention specifically that were not included in the Secure Act 2.0. There was a lot of discussion about backdoor Roth IRA techniques, and a few people are familiar with the mega backdoor Roth technique. Both of those are still available to those who qualify for it, and they were not affected at all by the provisions of the Secure Act 2.0. So for those of your clients who may have considered or implemented those techniques in the past, you may want to touch base with them, let them know that they're still good after the Secure Act 2.0. And then another thing is that the original Secure Act changed a lot of the rules with regard to inherited IRAs and inherited qualified accounts, implemented the 10-year rule. We were surprised by proposed regulations from the IRS last year that said if the account owner was taking RMDs at the time of death, that the non-spouse beneficiary also had to take RMDs in addition to having a 10-year liquidation deadline. And we held out a little bit of hope that that the IRS or Congress might change that. Secure Act 2.0 did not change any of that, mostly left the inherited IRA rules intact. And so to wrap this up, let me make a few observations. First of all, there's a lot of stuff in the Secure Act 2.0 surrounding retirement planning. Take a look at it and figure out which of your clients are going to be affected. The change in the RMD age is going to probably have the most impact of anything else, but there are certain specific changes that are going to have a great impact, perhaps be a great opportunity for certain of our clients. And so I think it's good for us to know what's there. And obviously the Act gives us lots of reasons to visit our existing clients and perhaps to talk about things to those that we want to make clients going into the future. So I'd like to thank you again for joining us today, and I'll turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, March 1st, at this same time. Next month's webinar will be titled, What to Know About Gift Taxes. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.